afternoon and good evening. Thank you for joining us this Wednesday as we discuss everything multifamily. I am very excited to have Brendan Brown from Infinity Investments with us as our panelist today, who's going to speak to multifamily after his years of experience in that asset class. And I'm also joined by Scott Picken and Gabriela Ferrais. Gabby has recently joined us, and I'm sure I pronounced that wrong. I'm sorry, Gabby, if I butchered your surname. But Gabby has recently joined our team as Head of Revenue, and we're very excited to have her on. So welcome, Brendan. Thank you very much for joining us today.
Thank you very much for the invitation and for putting this together. It's always exciting to share some knowledge with people, and hopefully they can take away some value today and go and apply it for themselves and create some wealth for themselves. So it's exciting.
Thank you. So just before I hand over to Scott, I would just like to remind you that we do have the chat box and the Q&A box. So please do give us your comments, your suggestions, your questions. I will be monitoring it throughout the webinar and asking Brendan to answer any of your questions that you do have. And with that, I think I'm just going to hand over to Scott and he can get started with this afternoon's webinar.
Excellent. Well, thanks very much, Lee. Really appreciate your time. So just a couple of things. I thought that what was important was that I just wanted to express the relationship Brendan and I have been on. We met each other back in, I don't even remember the exact year, but probably around 2007 through a mutual mentor called Dr. Hannes Dreyer. And one of the things that him and I both resonated with Dr. Hannes Dreyer was that most people, when it comes to property or real estate, focus on capital growth. That's very much what a middle income mindset is. And what Dr. Hannes Dreyer taught was that it was all about income. It was the first time I properly learned that, and I know that Brendan and I resonated with that. We became friends, and I was talking to him about what I was doing, and he was talking to me about what he was doing. And in simple terms, I went to America in 2010 to buy my first American property. They always say when there's blood on the streets, there's opportunity. And I couldn't find a single person I could trust. So much so that I could bore you with stories, and no disrespect, Gabby, but you know, I felt at the time in 2010, Americans would sell their sister if they could sell their house at the same time. You know, it just felt like this desperate situation. And I kind of went home after 5 weeks with my tail between my legs. And then Brendan actually invested, as I understood it, in 2011, and he had real persistence, and he kept hacking me and saying, no, America's a good place, America's a good place. And I'd already had my previous experience the year before. And long story short, we went back in 2012 together. And we actually had a very interesting experience where we did 7 cities in 8 days, which I know is crazy, and it was crazy. Looking at all these different cities, meeting different partners, really trying to understand the market. And really, it was mainly him and I and a guy called Neil Peterson that pioneered our whole journey into getting into America. And you know, if I share with you just some quick slides here. This was many years ago, back as far back as 2012, like I said to you. Sorry, let me just get the slides going. And we were actually doing buyers trips. So people would come with us and they'd say, oh, we'd love to come with you. And you can see Brendan and I right in the front here. And we were buying houses. This is actually Michiel Lucas, by the way, from Allvest. And we were buying, you know, these type of houses in Atlanta and other places. And then really from there, one of the things that we really wanted to do was to get into multifamily. And we really struggled with multifamily because there was so much demand for it. It was the most income resilient asset class through the last crash. And we just couldn't find it. And I remember a funny story where Brendan and I put down about $1 million. And we said, right, we're going to put it out there. We said to all these agents, and I think it happened to be Atlanta, we said, right, we've got $1 million and we want to come and buy property. And we sent it to, like, I don't even remember how many people. And Lee, I got a question for you. How many agents do you think got back to us when we said we had $1 million cash and we were coming to Atlanta to buy property? How many people do you think got back to us?
I would say maybe 1.
Yeah, it was naught. It was actually naught. And that's when we realized how small we actually were.
Yeah.
Where like $1 million in South African Rand terms was a hell of a lot of money to us. And we actually lied because we didn't even have $1 million cash, but we wanted to get their attention, and we were still treated, you know, nowhere. And so we really struggled, and, you know, we wanted to get into commercial property, and really, really it was this multifamily that really interested us, and it was common sense. You know, you rather than buying one house or one apartment, you buy a whole building. I won't steal Brendan's thunder as to all the different value adds and the income resilience, and quite frankly, we failed back in 2012, 2013, and what was really interesting to me is that Brendan, you know, with Migrate and with our different platforms at the Global Wealth Group and the private Wealth Global, the whole idea was that we really wanted to be able to enable different partners to be able to come on our platform with different access to different asset classes. Whereas Brendan was very passionate about the multifamily space. And so in 2015, went on his own and actually created this company here, which is Infinity, that has specialized in the multifamily space. And I think the one thing that I wanted to do as I introduce them is that the overriding thing that we look for in our partners is people that are specialized. And we always say there's three things that we look for in any partner. Now, we could go into, there's a whole bunch of things we do on the due diligence, but there's three primary things. The first is, do they have a speciality in a specific niche? And tonight and today's webinar is all about multifamily. And that's all we're talking about. We're not talking about American real estate. We're not talking about global real estate. We're talking about multifamily. Secondly, do they have a track record in the space? And as I said to you, Brendan bought his first multifamily in 2010 in Florida. I remember going to see it with him. And, so a tremendous track record. And that's in America. He was doing it in other geographies before that. And thirdly, and the most important one, and believe me when I say this sounds so simple, but it's very complicated to find, where you're dealing with partners that put their own money in. And I'll let Brendan tell you the amount of money they put in, but I'm talking millions of dollars that they put in alongside you and I as investors. And so without further ado, Lee, I wanted to hand over to Brendan to take us through what multifamily is and really to inspire and to educate all of us on an asset class that institutionally has been one of the most high value asset classes that they've invested in, and yet the majority of people have not had access.
Thank you very much, Scott. I'll tell you what, seeing some of those photos bring back some phenomenal memories. Hey? We had quite a few of those buyers trips, and everyone was something absolutely epic. So it was a great time. So thank you for sharing that. So what I want to do today, if everyone will allow me to, is to try and add as much value in the shortest amount of time possible, and really give you an insight into why we love multifamily so much, why I was so passionate about it, that it created a whole new life path for me, what we've been able to do in this space, and a little bit about what to look for, some of the risks that are now starting to present themselves through COVID and all the rest of that stuff, how to manage some of those risks, and what we're doing on the ground and what we're actually seeing on the ground in terms of how people are managing those risks and what's happening with real deals. I mean, we're actively buying deals right now. So let me jump in. If you don't mind, I'll share my screen and just give a little bit of background before we jump into, the due diligence and the underwriting and all that type of stuff. So let me see if I can get this here. Share desktop. Okay, so Infinity is the company name. We started in 2015. And here's a little bit of history of what we bought. We did buy some medical buildings. So we bought a Fresenius Medical Center because I also love the medical commercial space. This overlook building over here is a A-class office park where it was medical and some insurance tenants. But predominantly what we do is multifamily. And if you have a look at on the top left corner, that was our first project with Infinity. We raised just over $8.5 million in equity, was a $33 million total project cost, just over $33 million. And we sold it for $38.3 million after we'd finished construction. And I'd like to actually show you what it looks like now that it's finished, because I'm quite proud of that. So we built 263 apartments, and this is what it looks like now. Beautiful pool area. That's the outdoor kind of lobby with a Bruce Ball table and some sitting areas.
That's gorgeous.
Yeah, it's absolutely beautiful.
Family style also.
Yeah. Very cool. And this was the best in class product in this location at the time. This area is dominantly driven by industrial and medical. So there's a massive hospital very close to us. So we were the best in class in town in that neighborhood, and it was A class. So what I'd like to do, let me just go back here, is tell you a little bit about the different classes. Like what is multifamily? Multifamily is effectively a block of apartments that's held under one title deed. So it's not sectionalized or condominiums. If it were condominiums, those will be individual title deeds per apartment. In this case, we like multifamily because it's one title deed, so it's very easy to own it, very easy to sell it, very easy to finance it with good quality debt. And there's a couple of different classes of multifamily. So we own a whole block of apartments. That block of apartments can be what they call garden style or walk up, or where you've got maybe 3 stories of apartments stacked on top of each other, and you'll walk up the stairs, or you would have a lift core in it. When you start looking at high-rise stuff, that's typically very expensive developments that are developed out of concrete more than, multifamily in the US is generally built what they call stick and brick. So it'll be a concrete foundation with, with wooden construction on the outside, and sometimes with cladding, either brick cladding or vinyl cladding or wood cladding on the outside to create. And I'm sure Gabby can speak to this. You've probably seen hundreds of them, coming from America. So
I've lived in a few, yes.
You've lived in a few, exactly. We actually had a corporate let last year, and I actually learned a few things because one of the great rental management companies called Greystar, we actually use them on one of our properties. I was renting a corporate unit for our own use for one of our staff members, and I learned a few tricks that they use to increase income. So we implemented it across our portfolio. It was fantastic. So a couple of different classes. I know this is a lot of text. Let me just explain it quickly. Class A is typically newer built product that's very high end and typically rents for a lot more money, and typically to white collar workers. And it's the kind of the best quality buildings in their market or area. That's what we built with Kingsport, Tennessee. What we love buying is Class B property. So that's slightly older, but still in very good condition. Where we can do what we call a value add. A value add strategy is where we want to renovate either the inside or the outside or both in order to be able to boost rental income. And I'll show you why we want to be able to do that in a second, because the numbers can actually be, while very simple, quite staggering in terms of the results we can generate. So Class B is typically a little bit older. We're looking at more, worker orientated. So typically guys that earn between $4,000 and $10,000 a month, and we're renting to them between $800 and maybe $1,500 a month. And then Class C properties are typically 20 years old, located in slightly less desirable locations. The returns are usually pretty higher in terms of cash on cash returns when you're looking at it on a spreadsheet. But in reality, we bought quite a lot of Class C. It's Class C is, I actually call it the hot potato. Is you've got to get in, renovate, boost the rents, change the tenant profile, and then sell it as fast as possible before the next turn of tenants. Because if you don't move it that quickly, what tends to happen with that class of tenant is they usually don't respect the property very much, and you end up with a very high maintenance bill on lease turns. So when you turn those units, you want to make sure that you've got kind of one cycle of lease turns, and then you want to be out of that property for the capital gain. So Class C can be quite risky, which means obviously you're looking for slightly higher returns. So typical returns on the various levels. I mean, Class A would trade at a cap rate, and I'll go into what that is in a moment. At depending on the location, if you're in a tier 1 location, cap rates are 2 to 3%. That would be like a New York or a Los Angeles or a San Diego or that type of market. Class B would trade at a 4.5 to a 5.5% cap rate. In good tier 1, tier 2 markets like Atlanta, Class B stuff is currently trading at a 4.5% cap rate. In New York, it's trading at a 3 to a 3.5% cap rate. That was pre-COVID. New York's another animal at the moment. We'll speak to some of that in a minute. And then Class C stuff typically trades either on a per unit cost, because oftentimes you're not buying a Class C on a cap rate because the income isn't there to validate the value of the property. And you'll find most of the times the property values are driven by the income, but Class C, you've got to look at it a little bit differently and say, well, look, what am I buying it at on a per unit basis? Is it below replacement cost? What can I push the rent to? And then I'll value it on an income basis once I've stabilized the rent at the new value. So there's a little bit of insight, and I'm sure you can go and Google those different classes of properties and get a lot more information. So one of the major questions we always have to ask ourselves is why? Why are we investing right in the beginning? What are our goals that we want to achieve? What are our objectives at a personal level? And then does that asset class or whatever you're buying serve those needs, serve those objectives? You know, is it income that you want? Is it capital growth? Is it a bit of both? Is it dollar-based income? Is it just a hedge against another currency like the Rand or renminbi or whatever the case may be? You know, why are you personally investing and why do you choose multifamily? And what I can tell you is it's all about the income. So why institutions buy multifamily is they want dependable income that just lands in their bank account all the time. And here's why the income lands in the bank account all the time is in the US, and we've seen this in the UK, I'm sure Scott can speak to that as well. We've seen it in Australia, we've seen it in South Africa, is at the end of the day, everybody needs a place to live. It's a basic human need, and everybody either needs to choose to buy it or rent it. There aren't any other options unless you're staying with somebody for free, which has happened and does happen in South Africa quite often. But you know, it's really all about the income. And now the income, because it's about the income drives the value for the most part, except for Class C on the odd occasion. Now, what's amazing about that is if you can influence the income, and I'll show you some tricks on how to influence the income in a second. Just want to watch the time here quite carefully that we don't run out of time. Is if you can influence the income, you can influence the value. So not only can you collect great distributions for your own needs, so if your goal is, I want $10,000 a month so that I can live a life of freedom, a freedom of choice, and be financially free or financially independent. If that's your goal, then you want to be in a diversified portfolio. Here's why multifamily is so powerful is if you've got 200 or 300 or 400 tenants, all paying you a tiny amount, you know, on a syndicated model. So if you can't go buy a whole $33 million project on your own, but you can participate in a $33 million project as if you were buying the whole thing yourself and get the same kind of returns that the institutional players are getting, then you're getting a very diversified income stream, which means if you've got 300 tenants as an example, and one of them doesn't pay, it doesn't make a difference. If 10 of them don't pay, make a difference. If 20 or 30 or 40 of them don't pay, it doesn't make a difference. You're not going to get a phone call from the bank saying, hey, you need to put the money in, because there's enough income there as a buffer that you're protected. And it's all about the risk. We don't want to be in a risky situation where, and I've done it myself. I mean, when I started buying properties in South Africa, I bought the first townhome, and then I bought another townhouse, and then I bought an apartment, and then I bought a flat, and then I bought a holiday house. And then, so it progressed like that over time. And what I realized is when I've got one tenant, when that tenant doesn't pay, I have to find the money. I've got to put the money in. The bank doesn't care. I have to make sure that I can pay. So diversification of income is so powerful. The other incredibly powerful thing is if you've got 300 tenants paying you consistently, you have the economies of scale to employ quality people to be able to run those assets for you. When you only have one rental property, for example, and you use a property manager that's taking 10% of your income, they do nothing and taking 10% of them before you've even done anything, and usually a placement fee as well. So they take zero risk. They take a placement fee and they take 10% of your income for managing it. And you're sitting there saying, well, okay, I still need to actually deal with some of the stuff because the rental manager says, hi, you know, the roof's leaking and we've got 3 quotes and yes, and what must I do? Must I spend your money? Are you going to pay it in? What are you going to do? So the income is big enough on a scaled model with multifamily that you can employ great quality people on site to be able to manage this, which means you're leveraging other people's time to grow your own wealth while getting a diversified income stream. So you have less risk, less time hassle, and a much better prospect for growth because of those two driving kind of things. So why multifamily? I've talked about some of this already. Scott mentioned it. It was the most risk resilient asset class in the world. We tracked back all the way through about 40 years of history and measured the ups and downs of the property market around the world, and predominantly in the USA, because we're specializing in the USA, but also because the US is the biggest property market in the world by value. And multifamily is the biggest asset class within the property market. So there's a lot of data in the US. I mean, if you go look for Marcus Millichap reports or CBRE reports or anything like that, you can really get a lot of detailed information from markets on the different classes, on how they're performing, on what the debt's doing, and the influences of the market on those assets. Now, when we did the analysis, what we realized was through 2008, 2009, in general, the rents went down by an average of 5 to 7% generally, which means if you were at 95 or 98% occupied and your rents went down on average around 7%, you weren't in trouble, because if you've got an 8 or 10% positive cash flow on your equity, you're not in trouble if your rents have gone down 7%. Then what we also noticed is the cap rates, which drove the value, went up slightly, but on average was also around 7 to 10%. So your value might have changed, but because you had a lot of income at buffer, you were able to hold the properties through the downturn without having to get to a foreclosure or a negative position where the banks were calling on loans and that type of thing. So they could ride out the downturn much better than people that had to go and find the money when their tenants could pay, or where they moved out. And it was an absolute dog show in the single family space, 2008, 2009, 2010, which is why we were able to buy such good quality deals when Scott and I were hunting out single family homes. So because it's the most risk resilient, it means there's always capital chasing it. And this is very important, because you want a liquid market so that when you want to sell, you've got buyers bidding for your property. Now, you also want good quality buyers. What's extremely important here is the multifamily space is the most traded space in the world in real estate. It's in fact more traded than single family homes in South Africa, for example. So the multifamily space has a lot of capital chasing it, has a lot of buyers. And when you've got a good quality asset that's got great income, that's stabilized, it's very easy to sell. You got the diversified income. I've talked about that for a second. And the bottom line is number 5. It's affordable accommodation. That's a basic human need. And when COVID played itself out, we can see that where did people get relegated to? It was to their homes. So if you're providing a great space to live in terms of amenities, like if you've got a pool and a gym and a great garden space and walking tracks and that type of stuff, it becomes a phenomenal value for that person. And if we're providing housing, effectively it's homes. We've got to look at our tenants as customers, but also as people that we are providing a home to. And if we can provide a great place to live at a reasonable price, we will always have customers. So as a basic human need, I love being able to supply homes to people. I mean, in my family here, I just bought a house for my parents here in George. So, being able to provide homes is really a strong purpose for me. And that's one of the reasons I love investing in multifamily. So how to underwrite it? I'm going to give you guys a few tricks here on a spreadsheet that we look at. We do what we call, the back of the cigarette box calculation, or the back of the napkin calculation. Let me just pull up the spreadsheet here. And I'll show you why it's so powerful while we're looking at this calculation, right? So let's take an example here and say we're buying a property for $31 million. Now, what's phenomenal about Wealth Migrate's platform is these numbers can be $310 million, $3.1 billion, $31 million, $3 million, $300,000 or $30,000. It doesn't make a difference in terms of the number of zeros behind it, because anybody can participate now. And that's what I love about Wealth Migrate, because you can look at this asset now at a very high level, like an institutional buyer would, and say, if I had the $11 million equity requirement, would I buy this property? And if the answer is yes, well then, if you've got $1,000, then you can put it in alongside the other 10.9 or 10.7 million, whatever the number actually is. So that's very, very powerful. And most investors that I work with are very sophisticated, high-end, high net worth investors. Most of them are very savvy property investors themselves, or property developers themselves. So they're going to check my due diligence, my numbers very carefully. And oftentimes they help me negotiate better deals. I learn from my investor base because they're such good quality investors. And I've been very fortunate to have my own mentors become partners over the last 5 years. So let's take this example and say, okay, we're buying 389 units for $31 million at a cap rate of 5.75%. What does that mean? It means the percentage of the income against the purchase price. So our net operating income after expenses, so it's our net income after we put expenses being insurance, staff, maintenance, vacancies, property taxes, all of that stuff, but before debt. is 5.75% of the purchase price. That's the cap rate. So the cap rate is driven by market fundamentals. So it will typically be, similarly sold product. Let me just turn this off because my mouse keeps connecting and disconnecting. So similarly sold product in the area, that we're looking at might be trading at a 5.5% cap rate or a 6% cap rate, and we'll be able to get a feel for the market. What's phenomenal about this is, in order to determine the purchase price, is you've got to divide the net operating income by the cap rate. That's what drives it, which means the income is driving the value. That's a very important point, and I'm going to show you why in a second. Now, if we're borrowing 65% loan to value, which is roughly $20 million, this is a very, very important point, and I want to highlight this here. Let's highlight it in yellow. Why is it important? Because now you're leveraging somebody else's balance sheet. So I'll give you an example. The last property portfolio we bought was $76 million. We raised $24 million in equity, and our partner on the ground in the US signed for a $52 million loan with Morgan Stanley. He brought the loan to the table and he signed what we call the bad boy carve-outs. So it's a non-recourse loan. So only the property stands as surety for the loan. But if he is negligent in any way or commits any fraud or anything like that, then the bank can chase him down on his balance sheet in order to get the $52 million if they can't recover it from a foreclosure in the property or something like that. So it's very, very valuable because now investors that are partnering with us don't have to go be able to, be accredited to get approved for a loan of that level. And for a loan of $20.1 million, the usual criteria is you have to be able to prove that you've got the track record to operate a property at this level. The next one is you need at least 10% liquidity. So you need $2 million in the bank for at least the last 6 months liquid, and it has to stay liquid for the term of the loan. So if you're taking a 10-year term, your $2 million needs to stay liquid. And the bank does periodic checks. And if at any time you fail that, they can do a covenant call, or you have to put more money into the project. So it's very important that we've got somebody very wealthy who has the track record, the ability to perform on the project, and the liquidity and the net worth. The net worth is also 10%. So if you've got $2 million liquidity and $2 million net worth, now you've got an ability to get access to this type of debt. But I'll tell you this, during COVID, what happened is deals were still getting done, but you could only get access to the debt if you were already a client and had closed with Freddie Mac or Morgan Stanley or one of the banks in the past. They were not allowing any new buyers to come to the table that they didn't have existing relationships with because it was simply too risky for them at that particular time. So it's very powerful being able to leverage other people's mortgages. I think Scott used this the other day.
I was about to jump in and say, everyone knows OPM, which is other people's money, but actually other people's mortgages is even more powerful because you could come from Africa or India or South America or China, and you can actually turn up with $10, $20 million. You could probably even turn up with $100 million, and you don't have a track record. You're not an American citizen, and therefore getting favorable finance is virtually impossible. And this is probably one of the most powerful things that I've learned in the last 10 years, which is where, again, Brendan, you and I were buying houses, but as a non-resident, our cost of capital was close to 10%. Whereas,
yes.
If you've got a track record, I think you mentioned, Brendan, you're borrowing at 3.5%. There were 3.5%.
Yeah.
Call it half the price. Now, when it's half the price across 20, 30, $60 million, it's a significant difference. And so the power of partnership cannot be estimated or underemphasized here. And again, I don't care how much money you've got. This is why partners are so important.
Absolutely. And this is what gives you access to institutional level assets. And when we say institutional levels, the reason the real estate investment trusts and the private family offices and the private equity in these deals is they know the value of bringing somebody else to the table, because does he have skin in the game? If he's signing a $20 million loan and it's against his personal balance sheet, if he messes this thing up, even though it's non-recourse, the non-recourse has certain elements to it where they can still chase down your balance sheet if they feel like it. And you think the bank's going to chase down your balance sheet if you've got a 20 debt with them? They absolutely are going to, and they have the power to do that. do you think he's going to pay attention to the property? He's absolutely going to pay attention. And that's a phenomenal thing to have, because now you know somebody's really, really, really driven to make sure that this property performs, because his name's on the line and he's got $20 million against him, against his personal balance sheet, that if he messes this thing up, they're going to chase him down. So it's very, very valuable. So that means, in terms of the difference between our loan to value, and these are rough numbers, I'm just doing including closing costs and fees and loan origination fees and all the rest of that stuff. So our equity requirement would be $10.8 million at a 65% loan to value. We do sometimes take 70% or 75% loan to value. What we're finding at the moment is at 65% loan to value, we're getting much better interest rates, and we're also getting under Freddie Mac. So Freddie Mac is one of the biggest federal lenders in the US for multifamily. They are providing debt without any COVID carve-outs. So, the COVID carve-outs are sometimes they want 6 to 9 months, sometimes even 12 months of interest or repayments if they're amortizing it from day one. Those repayments prepaid into an escrow account that they hold, and you've got to maintain a certain debt service coverage ratio. So what are they saying? That you have to maintain a certain income level as a ratio against your debts before they will allow you to access that money. But it means you've got to overfund on your equity, and they lock that money into a lockbox, and you can't access it until you've proven that you are maintaining the property at a certain level. So what we want to do is find the best debt without those carve-outs if we can. So we're finding at 65% loan to value, that's kind of where we're coming in at the moment. And the terms that we're getting are between 3 and 3.5%, depending on the lender. So if we take it as an interest-only loan for 10 years, what does it mean? It means our repayment on the loan is $705,000 a year, right? So if we've got 1.7 million of net operating income before debt, so after all expenses, and we've got 700,000 in debt, that gives us a positive income after debt of just over $1 million, $1.1 million. And in terms of a cash-on-cash return, so now cash-on-cash is what we are measuring as a percentage of our equity. So the physical money we're putting in the deal, how much physical cash flow are we generating that's positive as a percentage of our physical equity that we're putting in the deal. And we always want to find a deal that's north of 8%. One of the reasons we're looking at certain areas, and I want to speak to a few areas briefly, is you're buying New York or San Diego at a 3% cap rate with 3.5% debt, you're pretty much not leveraging the bank's money for more income. You're just going to get your 3% yield, and 3% isn't really going to move the needle. It doesn't create enough momentum in your portfolio at 3%. We want to get to at least 8% for our investors to feel excited, and we want to make sure that 8% is real. So I'll go into some of the due diligence we do in order to validate that money, that it is real, the income is landing in the bank. Our tenants are good quality tenants. They are vetted correctly. They pay on time, and the income's real. And then we know we can rely on 8, 9, 10% cash on cash at the project level. And this is phenomenal, because that number, the income number, the free cash flow we pay out every quarter, is what determines your financial freedom. Because now you can reverse engineer and say, I need $5,000 a month to live a phenomenal life of freedom. Okay, how much do I need to invest in order to get to that $5,000 a month? Okay, it's $60,000 at a 8 or 10% cash on cash return. I need $600,000 deployed. Okay, if I take a 5-year program and I use some of the income to roll in, and what do I need to do? Okay, maybe I need to find $300,000 or $400,000 or $500,000 in order to create that income for myself that I know is going to come in relentless and regardless, no matter what. And what's great about multifamily is depreciation. Now, depreciation is a line item expense on our expense sheet that we're able to effectively take the value of the property, divide it by 27.5 years as an expense line item on the income statement. What's phenomenal about that is it effectively wipes out the tax on our cash flow, which means when I'm distributing an 8% cash flow, it's got 0 tax liability associated with it. It's phenomenal. Now, Scott can attest to this. You deal with some pretty high net worth guys. I deal with some pretty high net worth guys as well. And they always ask me, what's my after tax returns? Because they want to know that they're at least making some money in the range of 7, 8, 9, 10% in terms of a cash on cash return after tax, because they know that if tax is eating you at 20 or 30 or 40%, it's negating the whole benefit of that investment. So if we can use depreciation to our advantage, it's phenomenal. And it's very, very powerful, because what happens is, as an estate planning tool as well, is if you die, you can use what's called a step up in basis. So as you're depreciating the asset, your basis is dropping, which means when you sell the asset, you've got a higher profit, which results in a capital gain that's more, then you've got to pay more tax, which you can then use a 1031 exchange in order to defer that capital gain. But anyway, I'll park that there for a second.
Brendan, 2 comments I want to just talk about there.
Yes.
If people think that Brendan's just been speaking in Mandarin and Russian economics and you have no idea what he's talking about, that is one of the reasons why we do what we do. And the point being is that, none of you learn to run before you learn to walk. And a lot of you will be on this webinar trying to learn to walk. And I want to be clear again, you can have hundreds of millions of rand or ringgit, like you said, or any other foreign currency. But unless you've been investing for a decade in America, you won't have a clue what Brendan's just talking about. Okay, so, and this is again the value of partnership, Brendan, where there's 2 ways of doing this. The first way is you can go on a course. You can go, there's a whole bunch of ways, but the first way is where you do it all yourself. You can go on a course, you can get a coach, you can read a book, you can learn the hard way and try and do it all yourself, and it's going to take you 10 years to figure all this stuff out. Okay, and the second way is you partner with someone who's already done it, and the fastest way to success is to copy successful people. However, if you're aligned with them, you're going to learn while doing, and they've got your best interest at heart, and you've got their best interest at heart, blah, blah, blah. I just wanted to point that out, because I don't want the languaging you're using, Brendan, to overwhelm people, other than people understanding the power of this asset class and how to take advantage of it. However, you have to have a partner that knows what they're doing, because there's no ways you're going to figure it out in 3 months.
Yeah. No, absolutely. And I wanted to try and keep it as simple as possible, because I know jargon can sometimes make it intimidating, and that's not what I'm trying to do over here. But what I'm trying to show is that there are incredible tools in the multifamily space to be able to create wealth that's very, very tax efficient, which is why the very rich people use it so effectively. And what the Wealth Migrate team has been able to do is give access to people that might otherwise not be able to participate in deals like this. And to speak to one other thing is skin in the game. So something Scott mentioned earlier is we invest in every single project, and it's a principle that I actually learned from Scott. He often says it is, Zig Ziglar says, if you help enough other people get what they want, you'll get what you want. And what I want is a massive portfolio of over $1 billion in assets in the US. We're at 270 million or so at the moment. I want $1 billion in assets under management, because I know at that level, I'm not just rich, I'm very rich, and very rich gives you a lot of freedom to be able to live out your purpose. And even while I'm doing it every single day, it's the freedom of choice to be able to do it whenever you want to and wherever you want to. And we invest every single deal. So what I want is a very big portfolio. I'm looking for other people that want the same thing, and then I just invite them to participate in the same deal alongside us. And we typically put in between 5 and 10% of the equity in real money that goes into the cash. So if we need $11 million to buy this project, for example, we're putting in roughly between $500 and $1 million, depending on how much liquidity we have at any one particular time. But it will never be less than 5%, so that we've got real cash that we could lose, as well as signing for the loan. So we really are alongside our investors. And now I want to go to the next piece of it, is what if we can increase the income? And this is such a simple concept where we ask ourselves, we've got a tenant, he's paying us a certain amount of money per month, call it $800 a month. We've got to ask a simple question, right? If we increase that rent when it comes up for a renewal, is he going to move because we increase the rent by $30? The answer is no. He's not going to move for the $30. He's going to move because he bought a house, because his kids changed school districts, because of numerous other reasons, but he's not going to move for $30 a month, because it usually costs roughly $2,000 to $3,000 to move. If you've got to hire a moving van and 2 or 3 people to help you pack, I know this because I actually moved an apartment last year in the States, and it cost me $1,800 to move. So if you are looking to move a 3-bedroom unit with kids and stuff and everything. We were moving a 1-bedroom unit with, you know, a bed, a couch, a TV, and some cutlery, and they cost us $1,800, you know? So are they going to move for $30 a month rental increase? Usually no. They might move for other reasons, but not for $30 a month. And if you can increase the rent $30 a month for 5 years, it means you've increased the rent by $150 per unit per month in the 5th year. What does that mean in terms of income? Now we've created on 389 units, and I'm using that as an example because we're currently buying a portfolio in Oklahoma that's 389 units. So we've done, if you look at the calculation there, 389 units times our rental increase of $150 times 12. So that's our increase in net operating income, and while our expenses have pretty much stayed the same because there's very little real inflation in the States on the expenses side. And usually when we perform it, we'll put in 2 to 3% increase, but just in the session today, take it as $700,000 an increase in income after all of the expenses. If we take the same cap rate that we're buying it at 5.75%, and we divide this increasing income by that cap rate, it gives us an increase in value of $12 million. Now let that sink in for a minute. We've increased the rent by $30 a month, and there's lots of other things we do as well. We do revenue share agreements. So for example, one of our partners is Comcast and Xfinity, because we've got a portfolio of 850 units. Do you think Xfinity wants access to 850 tenants who become customers? Absolutely they do. So we do a revenue share agreement with them where every quarter they're paying us between $11,000 and $15,000 per quarter on that 850 units right now. So those little things that we bring in order to increase the income is sometimes not even related to the actual income elsewhere as a value add strategy. But all I'm showing you is a sum line item. Increase the income $30 over 5 is $150, which results in $700,000 in increase in net operating income at a 5.75% cap rate is $12 million in capital upside. Now, $12 million in capital upside is not why we're buying the property. I'm buying the property for this, for the cash flow. That's what I want. That's why I'm buying the property. But if I increase this income, not only has my cash flow increased, I've also increased the capital value at that cap rate, which means I've doubled my equity value. I've got 112% return. If I sell that property, I'm going to make $12 million profit. In 5 years' time, that's 112% gross return before tax, which is incredible. Now it gets even better. Let's say I can influence the income a little bit more by doing a renovation per unit. So I'll take $10,000 per unit and I'll spend it on the interiors and I upgrade them beautifully. We do granite tops, stainless steel appliances, thick plush carpet floors, that type of stuff. And we really make it beautiful. What does that result in? We're going to be with a total equity value of the 10.85 million plus our 3.9 million in extra additional equity that we require to roll out this value add strategy. And if all we get is $75 extra on those 389 units after we've rolled out the entire program, that results in our $150 of organic rental increases plus the $75 extra is a total increase of $225 per apartment, which is really not a lot. I'm talking about moving rents from $800 to $1,025 over 5 years, where you're delivering phenomenal value because now you're best in class in that neighborhood, which is unbelievable. Are they going to want to rent from you? Absolutely, because it's now beautiful. Which means we've increased the income by just over $1 million at a cap rate of 6%. So now I'm taking a slightly higher cap rate just for doing the numbers purposes, which results in less of a capital value growth, but it's still unbelievable because we created $17 million in capital upside as a profit on sale, which is 119% growth by rolling out a value add strategy, or what we call a forced appreciation strategy. Why is it forced appreciation? Because we're physically doing the work in order to increase the rental income. And I'll show you what a graph looks like where we rolled that out very successfully on one of our projects over the last 2 years. Where did the keynote go? So just to show you what that looks like, this is our collections on Alturas. This is 140 apartments in Atlanta. just in January this year, we bought this in June of 2018, and the collections in June of 2018 were roughly $150,000 a month. So we were able to increase it to $170,000 a month by January 2020. And during COVID, you'll notice here, we were able to push rents even more. We increased occupancy, and we were able to increase the rent on an organic basis. And we rolled out a value add strategy of renovating about 30 units. So we didn't do the whole 140 units. We only did 30 of the units, and we were at $194,700, which is nearly $45,000 a month more than when we bought it. But just this year alone, if you look at the numbers on the value increase at a 5% cap rate, which is higher than the market's trading at right now in Atlanta. Market's trading at around 4.5% for B-class assets. We've created an increase of $25,000 a month, which is $3,000 a year, which is $6 million in capital upside at a 5% cap rate. We bought it for $16.7 million with all costs included. We renovated for around $1.5 million. We did about 30 units interiors, and we did the whole exterior of the property. So we were all in cost of 18.2. And if we add our 6 million to our purchase price of 16.7, we're at an expected sale price now of around $22 million. And as it happens, we got an offer about 2 weeks ago of just over 23 million. We haven't completed on the offer process just yet. They're still negotiating. So we might end up selling it for about 23 million. But our expectation is after all said and done, we'll end up at about 22.5 million, somewhere around there. So it's very real. And I want to show you what that property looks like for 1 second. But it's after, let me just pull it up here. Where did it go? Hold on. This was when we were developing Kingsport. So when we bought it, it was all face brick, and now it's gray with red tones. We redid the pool area, we redid the gardens, we really made it pop. And as a result of that, with the stabilized rent and our occupancy of over 95%, we now have offers coming in at very significant numbers, greater than what we purchased it for. So anyway, that's that. And the last thing I would like to say, let me just get back to the keynote over here, is if we look at a real deal that's live right now, right, as an example, where we're purchasing a project for $31 million, it's 389 units, which means we've got 389 tenants, which gives you diversified income. We're getting debt at 3.5% fixed for 10 years. Which is unbelievable, because if you can fix your rate for 10 years, you know what your expense is, which means you know what your income is going to be, which means we're protected. It's an unbelievable position to be in, which is very low risk with after-tax income of north of 8% coming in. It's incredible. So I'll be buying that stuff all day long. So I'm going to stop sharing my screen now and invite Scott to ask any questions.
I'd love to start, Brendan. Thank you so much for this overview. And I think just from that, it's inarguable that it's valuable to invest in multifamily at this point in time, given the year that we've seen, the pandemic, and how it has impacted so many individuals remotely working, especially individual. I think we've kind of talked a bit about, outside of this, the city exodus and individuals seeking to live in other areas, but still wanting different amenities or being used to certain amenities, and how multifamily can contribute to that. I'm curious where you see the trend of multifamily going, especially in the next 5 years, 10 years down the line, in this new remote world that we find ourselves in.
Great question, thank you. And there were a few different questions tied up in there, but so where do I think
there were a lot
going?
of points.
I would definitely say outside of urban city centers. So what was nice about our Kingsport one is it was urban, but you're in a relatively small kind of tier 3 town. So it's not heavy urban, it's not like downtown New York or downtown Atlanta or something like that. There is a big exodus outside of urban centers. Nobody really wants to be around, 20, 30, 40,000 people every single day right now. They want more spread out, more garden style. They want to be able to go to the pool at their own kind of time. What we're also seeing on the amenities list that people want is an office center where they can do, where we've got video conferencing facilities and that type of stuff. So at Alturas, for example, we created a business center for them that is now getting used quite a lot, and it was almost never used in the previous year. So those types of amenities make a big difference to your tenant really enjoying the space. But suburban areas that are kind of 20, 30, 40 minutes outside of an urban area are definitely performing better than downtown urban product at this point in time because of the exodus. What's also happening is people are looking at buying, single family homes. So the single family home market is getting driven very hard at the moment. And that's also because interest rates came down significantly in the last year. So where people can access debt at a much lower rate, if they had some savings and they're saying, look, I don't want to be in an apartment complex anymore. I want to feel safer. Let me go buy a house. So what's happening is the house prices are going up because the interest rates have come down, but it's also driving multifamily prices because the interest rates are so low. Multifamily prices have also gone up. I would definitely avoid, this is going to sound terrible, but any Democrat-run states, simply because the tenant laws are very onerous and they're very protective. So it will typically take you anywhere between 3 and 6 months to evict a tenant that's not paying in a Democratic-run state, versus a Republican-run state, it's typically between 6 weeks and about 3 months. To bring up one other aspect around COVID that's happening right now is the CDC put in place an eviction moratorium until the 31st of December. And that eviction moratorium, excuse me for 1 second, doesn't apply to every single tenant. It applies to around 40% of the tenants in the market. And it's put landlords in a very precarious position, because what they're saying is the spread of COVID can be driven or is by people that might be put out on the streets, or if somebody has to go to an eviction court proceeding, they're now exposed to more people. They don't want that to be happening. So we are finding that delinquent tenants that that have like a reason for their delinquency being related to COVID can stay in your apartments for quite a long time without you being able to evict them. Whereas in the past, we were able to evict them. But it's not that bad. I mean, on the ground, when I look at my actual rental collections and rental numbers, is people are still paying their rent. So even though they could not pay, they're still paying their rent. And the reason that
I imagine, oh, go for it.
No,
I was going to say, I imagine that
there's a lag there. You go ahead. I'm going to stop talking.
Sure. I would say I imagine that the class of building that you're investing in, so if you're investing in the Class A multifamily structure, that type of tenant is going to be someone that's going to retain their job, they're able to work remotely, they're able to continue paying rent. The amenities you offer may need to be at maybe a higher tier, but that does make, I imagine, multifamily a bit more of a savvy investment, especially the Class A property, because of that component of who your tenants are and who you're trying to retain.
So what they've found is with the eviction moratorium, anybody that earns above $99,000 a year, so if you've got good quality tenants that are earning $8,000, $9,000, $10,000 a month, they're not going to fall into that category. Also, the rental obligation doesn't go away. So it stays on their record and they still owe you that money. So what the people are saying is, if I've still got the income, I don't want to have a position 3, 4, 5 months from now where I owe the landlord $5,000. I'd rather just actually keep paying, because otherwise they'll be too far behind and they'll never catch up. So we're finding, as long as we work with our tenants, what we do is the program that we run is they must give us a letter from their human resources department that shows an effect on their income, or proves that they've been furloughed or laid off or whatever the case may be. And then we'll work with those tenants. And when we've asked for that level of detail from the tenants that have chosen to use COVID as an excuse to not pay, generally they actually start paying. It's too much work for them to go and get the paperwork, and they actually are still getting an income, so they just continue to pay. So, but it has been a case of where we do work with our tenants. We understand the position that everybody's been put in, and we actively try and help those people so that we don't end up in bad situations. It's also been phenomenal is a lot of our tenants are subsidized by some sort of housing subsidy. So maybe it might be the Atlanta Housing Authority or a Section 8 tenant, or oftentimes we have churches that help people. So we've got a bunch of leases with some churches. We have the property we're buying in Lawton, Oklahoma right now is 51% military occupied. So, you know, when you've got the government paying your rent, you're generally going to be okay, especially when they're printing stimulus checks in the trillions of dollars. So we've found that in general, people still respect the leases, they still respect the law, and they know that it's going to be on their record, on their credit if they don't pay, and they generally pay. They are trying to mitigate the eviction wave that could come in January or February next year when this eviction moratorium, you know, is lifted. But you know, on the whole, we haven't found it too difficult in the markets that we're in. And the reasons we've chosen the markets, it's very important, is we want a diverse economy of employers. So we don't want to be only exposed to tourism. You know, we don't want to only be exposed to hotels or restaurants. We'd be completely smashed. What's nice about Atlanta, for example, is, you know, Delta got smashed horribly and they're the biggest airline in the world. But, you know, Atlanta's got 75% of the Fortune 1000 companies have a head office there. So it doesn't matter that Delta got smashed, because there's still the biggest movie production houses. There's still Coca-Cola. There's still CNN. There's still ESPN. There's still the Atlanta Braves. You know those economies still drive those areas very, very, very strongly. Oklahoma, for example, was exposed to oil. So when the oil price tanked, when COVID went down quite dramatically. But what we realized is Oklahoma, and part of our due diligence last year when we bought our portfolio of 5 assets over there, was how exposed are we to oil? And the oil only makes up between 8 and 10% of the economy over there anyway. And there's so much other industry that we've seen no impact on our multifamily holdings whatsoever. In fact, we're still pushing up rents because nobody can build competing products in the market for what we're providing our tenants. I mean, I'll share my screen quickly for you to show you some of the amenities. And it really is about, the amenities are everything, because it's that extra value add that you're providing to your tenants that they don't need to pay for somewhere else. So for example, a gym on site, a gym membership is going to be $50, $80, $100, depending on if you're paying for spinning classes, Pilates classes, and your gym membership. Whereas if you've got a gym on site, you're saving that person that extra $100 a month, you know? We've got a beautiful pool. We've got grassy areas. We've got dog parks. We've got a basketball court. I mean, this is the one we're buying right now. And it's an A-class product that recently had $3.2 million in capital spent on it. So it's incredible. And we've got 51% military tenants. So we know we've got stable income for the next 10 years because that base is one of the biggest bases in the world. And it's been going for 200 years. So it's not going anywhere at this point in time. So let me just stop sharing there. Thank you for that question. And
great, thank you. I jumped the gun, so Scott, I don't know if you have a question on that.
Yeah, I know you had a whole bunch of questions that you wanted to run through, including what Jing had sent through. How do you want to do that?
I think maybe let's just ask 1 or 2 more questions. I want to be mindful of the time. But something that we didn't touch on, and I'd love to get your opinion on this, Brendan. Some of the properties that you've shown us that Infinity has invested in were properties that already existed. But I'm seeing generally that, you know, ground up construction and this concept of building to rent are becoming more and more frequent, more and more like major opportunities for investors, especially in the multifamily space. So could you just talk to us a bit about that build to rent concept, and if you think it's something that is going to be in demand, just your take on it? I would appreciate that.
Yeah, so without revealing too much, we're actively buying land right now. So you know, when I believe in it so strongly that I'm actively buying land and I'm putting my own money in, you know that I really do believe in it. And here's why, right? There's a shortage of housing stock that they estimate in the next 10 years of roughly 4.5 to 5 million units that are going to be short in the market. The population is still increasing. The US is still a place that people want to move to, even though it's in a weird space right now with elections and Trump and all the rest of that stuff that's going on. It's still a great place in terms of the freedoms that it enjoys, the reserve currency status that it enjoys, the dominant economy that drives everything else around the world that it enjoys. So it's still a great place to live and work and be. So there's a massive shortage forecast, and somebody needs to build that. Now, the opportunities that present themselves are interesting. Like, we built 263 apartments in Tennessee. We built 303 apartments in Greenville, South Carolina. That's ongoing construction right now. So we are seeing it in reality, becoming something real. Big institutional players are actively backing big developers right now to be able to grow their portfolios, because they can't buy at the right cap rates because there's no real income. So they have to build at the right cap rate, because right now it's sometimes cheaper to buy than to build than it is to buy. We look for properties where it's cheaper to buy than to build when we're buying stabilized assets. So we want it below replacement cost. But if you want institutional stuff in good quality areas, oftentimes you can build for less. So that's also driving the need. The other element of it is new product is very valuable for the mindset of where the market's shifting to. People don't want to own the house anymore. They want flexibility and freedom of choice. I mean, you could speak to this as well, is if you want to be able to travel and you've got a 12-month lease, you say, well, at the end of my lease, I'm going to disappear for 6 months to the Caribbean, and then I'll come back and I'll rent another apartment. So they want good quality housing accommodation. They want it in great locations, but they want flexibility. So even though the interest rates are some of the lowest they've ever been, sales are still not trending up at the rate that they should be trending, considering how low the interest rates actually are. And home ownership, where it was generally around 65 to 66% of the market, is now around 61%. So it's still trending down, even though interest rates are so low, which proves that people want to rent. And they want to rent on shorter and shorter time spaces with more amenities. They don't want to mow the lawn. They don't want to look after the pool. They don't want to, they don't want that stuff, but they still want a great garden. They want a nice place to sit. They want the outdoor furniture. Now, I don't know when last anybody bought outdoor furniture, but it's ridiculously expensive. I mean, we spent over $100,000 on furniture around our pool at Alturas. And, if you've got a pool at your house, you can easily go spend $15,000, $20,000 just on furniture. People don't want those expenses. They don't want to even clean up, after their pets. So we have a dog park, and we've got maintenance people and that type of stuff. So they want those amenities without having to buy it. So the multifamily space is absolutely going to continue to grow as long as capital keeps chasing it at the rate that it's chasing it. And right now, on a risk-adjusted basis, there's no better place to park your money, which is why Blackstone and them are deploying hundreds of millions and billions of dollars into the space.
It's such a great point, and it's something that speaks to not just a certain age group or profile. I mean, certainly individuals, I think, in my kind of age bracket and demographics definitely are looking to continue to rent for a time, but even baby boomers and those that are entering into retirement are looking to, downscale their homes, maybe renting instead of keeping a home, to be able to just release themselves from that maintenance of home upkeep, et cetera, et cetera. And so in a sense as well, that demographic is growing as that age group grows older and realizes that they don't want to deal with the admin of maintaining their home, upkeeping their home, rather just move into a really, nice A-class multifamily investment.
It's so funny you say that. So that Lawton, Oklahoma project that we're buying right now, about 30% of our tenants are retirees. So they're like, and they want all the ground floor units. They're like, I don't want to walk up the stairs. I'll just take the ground floor units. So it's so interesting to see that. What we're also finding is a massive shortage of very high-end A-class townhomes. So where people don't want a neighbor above them, with the walking going doof, 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 doof on your ceiling all day. So they want their own space with no neighbor above them. So if you're developing a duplex on top of a garage, which is typically a 3-story kind of townhome concept, there's a massive demand for that type of stuff. And most institutional players are not providing that or not buying it, because what tends to happen with townhome developers is they run it on a build for sale model. So they'll build townhomes, sell them to individual owners, and then the homeowners association will determine the rules of the project. And then you'll typically find smaller buy-to-let investors that buy 1 or 2 units for their own retirement plans over time, will buy 1 or 2 units in a complex like that. but there's such an undersupply of that type of product in the market right now that we're definitely looking at those types of opportunities.
That's great. And do townhomes, and is that also classified as multifamily?
So it depends. So oftentimes the townhomes, you can have townhomes that are classified as multifamily if it's one title deed and the development was done as a multifamily kind of development, even though they're townhome style design. So we own one like that. We've got 86 units in Atlanta that are townhome style while being multifamily because it's owned under one title deed. And then the townhome style where it's kind of condominiumized, or where you buy your own, pad site with one townhome on top of it, is, that's also available to most other people, but then it's not multifamily because it's on a per, individual house type of title deed.
Great. Thanks. I'm mindful of the time.
Yes.
Yeah.
Lee?
Lee?
Sorry, I just had one more question to ask. During the downturn of the economy, 2008, 2009, the real estate market presented a whole lot of interesting, new, sexy markets that were available because people were overextended. Are you seeing any, you've spoken heavily about Atlanta and Oklahoma during this presentation. Are you seeing any new markets that are opening up to you due to COVID and the downturn that is currently happening, and people that were unexpectedly caught by being overextended?
So with risks comes opportunity. So like Scott has said quite often, and Warren Buffett I think said was, when there's blood in the streets, there's opportunity. So one of the projects that got presented to us about 2 months ago was an extended stay hotel, which is effectively studio apartments, where they're saying, let's not run it as a hotel anymore. Let's go back to apartments and run it as a multifamily complex, and we can pick it up for well below replacement cost on a per unit basis of, call it $60,000 or $80,000 per unit. I can't remember the exact number. But if we're buying 100 studio apartments at $60,000 a unit and we tenant them up, and on a cap rate basis, they're worth $100,000 a unit, absolutely that's an opportunity we're looking at. So extended stay hotels that can convert to multifamily, definitely something that's very, very interesting, especially in kind of tourism areas that have an element of a different economy, like let's say Orlando. We've got Disney that's gotten smashed by COVID, but at the same time, they've got a bunch of other things going for them. They're still tourism oriented, that's drivable distance from a whole bunch of other places. For the lakes, they've got a lot of medical tourism and a lot of shopping tourism because of all of the retail outlets that they have in Orlando. So they've got other elements that are going for them that drive their economy that's not just tourism based, but because there were so many tourist oriented hotels and extended stay hotels that fed into the tourism market over there, those opportunities are starting to present themselves. We're seeing it in Tampa. Tampa is becoming a phenomenal growth city for a bunch of different reasons. So one, no state personal income tax in Florida. Number two is it's on the Gulf Coast, so you're getting a little bit less exposure on the hurricanes coming across from the Atlantic. So you've got slightly lower insurance costs, and it's got an incredible lifestyle and a downtown area that's been driven by Bill Gates, and there's another billionaire that he partnered with, where they're doing the whole sort of wharf area, a waterfront area that they're converting over there, and they're spending about $2 billion on that area in Tampa, and it's driving a huge amount of development around it because of that. Other areas we're seeing go down is people don't want to live in California. Like, we're seeing an exodus out of California that's second to none. They don't like the fires, they don't like the government, they don't like the lockdown, they don't like the high tax, so we're seeing a very big exodus out of California, a large exodus out of New York. So an interesting thing, one of the reasons we chose Oklahoma is last year they opened up for the first time a direct flight from New York to Oklahoma City. Now, what that did is it brought very rich Jewish property investors to Oklahoma chasing yield. So because they were chasing the income, they were buying properties at a 6 or 7% cap rate in Oklahoma that they couldn't buy anywhere else, because the Atlanta market was already at a 4.5% cap rate. The North Carolinas and South Carolinas were trading at a 4.5 to 5.5% cap rate. So if they wanted yield that they couldn't buy anywhere else, they started flying to Oklahoma. So that was an interesting development that happened. there is a large exodus of money and people out of the New York area. And people are also just saying, you know what, if I can work from home, I want to be in a beautiful place. I want to be in a place with good amenities. I want to be on the water, or I want to be in the mountains. I want to be on a lake. You know, they want something that's really nice, instead of a tiny apartment for $4,000 a month in New York. They're like, well, this is terrible. I can't go to my restaurant, it's closed. I can't go to the cinema, it's closed. I can't go to the gym, it's closed. Well, I actually really want to be close to nature. I want to be able to talk to my neighbors. I want to be able to do certain things. And then they go look for that somewhere else. And that's driving a huge amount of our demand at the moment in the sort of suburbs outside of downtown Atlanta, where we've got great weather. We've got great locations in terms of shopping and amenities and that type of stuff. We're seeing huge growth in that. And then also in the Floridas, because of the tax and because of the lifestyle. People are just saying, you know what, I really do want that lifestyle. I don't like being locked down in a tiny little apartment, and that's driving a huge amount of growth. I mean, we're also seeing it in Ohio. You know, people are saying, I don't mind being in sort of smaller towns. They're looking for that feeling of community again, and they're looking for it in small towns. And the smaller towns is what's driving the massive amount of growth, because you can buy in tier 3 markets like the Oklahomas at a much better income ratio or cap rate.
Great, thank you very much. So I think we have come to the end of our webinar. We are 15 minutes over the time, but as you can see with the comments that are coming in from our community, they've absolutely loved the learning experience. Brendan, you are always such a treasure to have on our webinars, and the generosity of what you share. Thank you very, very much. We really do appreciate your time and your energy.
Thank you very much for having me. I hope it was valuable. And if there are questions that come through, I'm not sure if you want to ask them now or get back to anybody later. You guys can tell me how you want to deal with that.
Yeah, so there were a few that we need to handle offline. I will definitely get in touch with you and get some more details from you so that we can pass those on. But you covered 90% of the questions that came through. A very, very comprehensive presentation. So thank you very much. We do appreciate it.
An absolute pleasure. Thanks, guys.
Scott and Gabriella, thank you very much for joining us and being part of our webinar this afternoon. It really is great to be sharing with our greater community. To our attendees, thank you for spending the last hour and 15 minutes with us. As always, your time is the most precious, and we really do appreciate it. Tonight at 7 p.m. South African time, Brendan is going to be one of our panelists for our fireside chat, where we are discussing the impacts that the US election is going to have on the American and the global economy. We have 8 panelists from around the States and also internationally that are going to be joining us for that webinar, and we really invite you all to come in and share with us and be part of that conversation. I have put the registration link in the chat box, so come and join us tonight at 7 p.m. South African time, 5 p.m. GMT time, for a chat around what we can expect to happen post the US election. Regardless of who wins, this is not a discussion on who we believe is going to win or who should win. It's the impact it's going to have regardless. And I know that we are going to have 2 very distinct camps tonight from our attendees and also our panelists. So we look forward to that. Thank you once again for joining us. And wherever you are in the world, we hope that you are safe. Be blessed, and we will chat soon. Take care.